Hello everyone. Yet another solid week for commodities except oil as a US dollar corrected falling below the 107 level. Can commodities rally for the third straight week or will the US dollar make a comeback? Let's understand what's in store for us in this week's commodities podcast. I'm Ravindra Rao from Kotak Securities Commodity Research Desk, and as always, I'll guide you through the commodity fundamentals and price action that will help in taking an informed trading decision. Focus in the previous week was on US CPI data after a few disappointing monthly data prints from the US in the first week of November. Commodities that started rallying in the later part of the first week in November continued to move higher in the week gone by as US CPI data fell more than expected in October. Headline annual inflation dipped to 7.7% in October, down from 8.2% in the previous month and below the 8% expected. A decrease in US CPI inflation might prompt the Federal Reserve not to implement jumbo rate hikes. Slow pace of rate hikes by Fed is negative for the US dollar and positive for commodity prices. Additionally, Chinese easing of quarantine rules sparked a risk on sentiment in the entire global market. The major pain for dollar came after the US CPI data that surprised on a downside, bolstering Fed's slower pace of rate hikes in future and cementing a 50 basis point rate hike for December FOMC meeting. The Fed funds terminal rate, which was seen at 5.07% ahead of the CPI data, fell to 4.87% in May 2023, post the inflation print. Although the inflation print has supported a slower pace of rate hikes, price pressure is still at an elevated level and much above the Fed's target rate. Having said that, focus will now shift to the US PPI and US retail sales data. Retail sales for October is expected to come at 0.9% as compared to 0% in September. A better than expected print might help dollar to erase some of the losses as Fed could continue to focus on inflation. On the flip side, a drop in retail sales print would heighten the expectation of a slowdown in rate hike by Federal Reserve. On the technical front, US dollar index has penetrated a rising trend line support, indicating a temporary top. Immediate resistance would be near 107.50, whereas strong resistance would be near 109.50 to 110. The bears might try to push the index low towards the next support of 104.60, provided 107.50 holds on the weekly on the weekly closing basis. Coming to commodity specific, precious metals staged a fantastic rally in the previous week, gaining for the second straight week. COMEX gold rose 5.54% on a weekly basis and closed at $1769.4 per troy ounce, whereas COMEX silver closed at $21.66 per troy ounce, up by 4.25%. Uncertainty in US midterm elections has supported the precious metals as the greenback plunged by more than 4% to below 107 levels. Now, this is over and above the CPI data that supported the bull case in the shiny metals. Owing the repricing of the rate hike curve, US 2-year and 10-year Treasury yields fell 31 bips in the previous week, underpinning the non-yielding yellow metal. The rise in price has prompted investors to return to gold, as indicated by mild inflows in SPDR gold ETF holdings. However, the holdings are still at early 2020 lows. A focus for the week will be on the US retail sales numbers. An above expected print would prompt a recovery in US dollar, which will be negative for precious metals and vice versa. On the price action front, COMEX gold has taken a strong triple bottom support near $16.20 and has risen more than 9% in just 2 weeks. Immediate resistance is near $17.80, followed by 52-day moving average resistance near $18.09. The bulls might target the above two resistances before we see some corrective move in the price. On the MCX, price has penetrated a falling trendline resistance as the bulls might now target the immediate resistance near 52,600. A daily close above 52,600 might be further bullish as the next resistance is close to 53,670. In case of COMEX silver, resistance is near $21.80, which is the 252-day moving average resistance. Earlier resistance of $21.20 would become the immediate support, followed by a $20.80. Break of $21.80 on daily closing might push the price towards $22.50. On the MCX, price closed above 252-day moving average resistance near 61,200. However, the bulls are facing a hurdle near October month high of 62,370. A close above 62,400 would give the bulls the edge to take the price past 63,000. Coming to energies, WTI crude oil futures traded between $85 and $95 per barrel in the previous week and closed 3.94% lower at $88.96 per barrel. Oil prices started retreating earlier last week as EIA's downward revision of demand growth, sharp increase in COVID cases in China, and reiteration of a commitment to COVID zero policy in China weighed on the outlook. In its short-term energy outlook, EIA has cut its 2023 world oil demand forecast by 320,000 barrels per day to 1.16 million barrels per day. Further pain was inflicted from an unexpected build-up in EIA inventory data. However, oil prices staged a decent rally in the last two trading days, up almost 3.5% amid a weaker dollar index coupled with soothing news from China after China cut the quarantine period for inbound travelers. Oil prices might trade with a sideways to upside bias for the week as supply concerns might once again take center stage. Weakness in dollar index and relaxation in China's COVID restriction might aid the bullish sentiments for now. On the charts, WTI crude oil has taken good support near $85 per barrel and has moved higher. Immediate resistance is near $90. A sustained close above $90 would support the bulls as they might push the price once again towards the 252-day moving average resistance near $93.50. On the flip side, a break and close below $85 per barrel would support the bear case. On the MCX, support is near 6880, whereas 252-day moving average resistance is near 7320, which the bulls might target this week. But 6880 should hold on the downside on a daily closing. Finally, in case of the industrial metals, the entire base metals pack have jumped in the range of 5 to 15% this week on weaker DX, following softer US inflation figures and supply disruption in some of the metals. Copper jumped over 6% to $8,600 per ton as recent reports of easing in COVID rules in China provided a further boost to the commodity already buoyed by disruptions at major producing nations, higher premiums and lower inventories. Base metals may see a pullback this week as LME decided against ban on Russian metal, saying that a significant portion of the market is still planning to buy the country's metal in 2023. However, US dollar weakness might keep prices supported at lower levels. Additionally, release of key economic indicators from China will be watched to take a cue on the economic health. On the price front, MCX copper has sustained the breakout of the symmetrical triangle. As per the break, the upside target is pegged near 725, which is the 252-day moving average resistance. However, a throwback towards 685 can't be ruled out, which might attract buying again. With this, we come to an end to this week's commodity podcast. Keep a watch on US dollar as that would continue to drive the commodity markets. All the best. Have a safe trading week.